Ladies and gentlemen, now onwards with the show. Now, our first session is going to be a panel about selling your SaaS startup from 3 fantastic venture partners. What is the investor perspective? We are going to unpack that today. And ladies and gentlemen, please give you a round of applause for my panel, including Bouck from Insight Partners, Cathy from Sapphire Ventures, round of applause everyone, and Reynolds from Vertex Ventures on why VCs are going to support your move to sell and how you're going to do it. Thank you so much for joining us at TechCrunch Disrupt. Let's get straight into it. Let me get my notes up here. We are in a strange moment, I guess, over the last few years. We've had the period of ZIRP, which is now my new favorite phrase, zero interest rate period. Which I just thought that was just my life. But obviously it was a very, very, big bull run, and now we're sort of supposedly in a bit of a bear market, which actually, is when startups often come back and get going. But the exit market is a little bit squeezed these days. So let's just sort of go around and just ask the question about where you think we are. Whit, where do you think we are right now in the sort of the exit market?
Yeah, well, it's certainly, as you said, been an interesting period the last couple of years. I think we're in a bit of a transition period. We've obviously seen a quieter market the last couple of years in every respect, really, investing, IPOs, and acquisition. But I think we're about to see a pretty significant uptick in the acquisition space, primarily because we saw so many companies pre-market change take investment dollars that only last so long. Most people take a round of financing thinking they're going to do another one in the next, call it, 3 years-ish, give or take. And so we're in about that period where people are going to start running a little bit low on cash, and that's going to create an interesting decision point for people. Is there enough, appetite to take on more money with the current conditions and kind of, what the terms that are willing to be accepted or not? Or is it time to maybe find a partner and merge and or sell to kind of find a new path and maybe get backed by somebody else?
Cathy, so Whit thinks we are in a transition place. Do you think we're in in an inflection point? Or do you think that maybe we've got a couple of years more of this sort of, will they, won't they kind of a market?
I think we'll have a more precise answer to that exact question very, very soon, because of course we have Instacart and Klaviyo IPO coming up, which will be a bellwether for the IPO market. But I think it's important to note that there's different types of exits, right, for a venture-backed company. Whit mentioned this, but there could be M&A, strategic exit, there could be a merger, and there could be an IPO exit, amongst others. And with every cycle, we see different volumes of each type of exit. For the past several years, the IPO markets were frozen for many macro factors that I'm happy to go into. And the M&A markets were also relatively quiet, which was surprising. We have seen the M&A markets come back significantly, I would say, in the last several quarters, particularly in my world, in our world, startups who are acquiring other startups. So larger, well-funded startups have started to do tuck-in acquisitions, and I fully expect that to continue. We've also seen large private equity firms take companies public who were previously, private who were previously public. So there's been activity scattered, but I think time will tell in the next week or so how we should think about the future.
Right, so I see. So you're setting it up as more of an M&A market, consolidation,
yes.
Correct? Right. So Megan, I know that you were formerly at Entrepreneur First, which is considered one of the better company builders out of Europe, but it's also gone global in Asia and the US. And now you're obviously with Vertex. You're playing more at the early stage, but it's much harder to do M&A at that early stage, though, isn't it?
It's a good point. I guess harder to make large strategic deals happen, but I would say a majority of the M&A that we're seeing right now, you would call maybe more of an acqui-hire. I'd say that's probably the balance to the IPOs, the kind of strategic acquisitions. And so far in that market, we've actually seen a load of activity in the last couple of years, and I think that will continue, especially with the buzz around AI. And so for investing in the pre-seed, if you're building, if founders are building infrastructure software, machine learning, AI software for those companies, like often they'll have maybe 10 or so acquisition offers before they hit the Series B. And so for that market, it's very, very high octane. Still.
Oh, I see. So, it's almost like a talent marketplace to some extent, in a way, as you mentioned.
So for those scale of acquisitions, call it maybe a $10 million acquisition up to, I mean, we're seeing larger ones around the 100 million, but I'd say more typically like $10 to $50 million acquisitions. For those acquisitions, it's usually talent, it's technology. And so they're not buying a company per se, but they're buying the technology that you've built and maybe the PhDs that you brought into your team, and that's basically consuming that into the organization. So it's not a traditional acquisition in that sense.
I suppose also because there's so much activity around generative AI right now, people are going like, wait a minute, you're working on the same thing, let's get together kind of thing. Maybe that sort of thing's happening. Let's kind of slow down a bit, and what I'd like to do is draw on your respective experiences. I know that you have a fantastic resume and experience in this space. Dropbox acquired HelloSign, which you were part of, and you've been part of, I think, 17 acquisitions.
Yeah. Thankfully, mostly on the buy side.
Right. And so you were Chief Operating Officer of HelloSign, and you've done so many other things. I'd be interested to know, like, sort of, looking back, what sort of experiences, what some of the interesting things that happened when you were selling the companies that you were part of?
Oh boy. And I'll give you one really interesting story on the buy side, and then I'll give you one really good one on the sell side. So I remember we were in the midst of acquiring a small company. It was not quite an acqui-hire, tuck-in type of acquisition, but close, like 30 employees kind of thing. And we were, let's call it 9 steps down a 10-step path with them, right at the end. And we got the 2 executive teams together to kind of start planning and networking and getting to know each other. And it was like a junior high school dance. Boys were over there, girls were over there. Like, we know we're supposed to talk to each other, but we can't figure out what to say. We could not, for the life of us, figure out any way to connect with one another. And we walked from the deal. We bought the second tier player because we're like, this isn't going to work. And I think it was a really, really smart move.
Was that because there wasn't a cultural fit, or?
Exactly. Yeah, and I think I think culture fit is really underestimated, actually, as to how successful an acquisition will be. Yeah. Because if people aren't happy and there's no culture fit, they'll feel kind of, disenfranchised, they'll leave, and then you lose the very thing, or at least a big part of the very thing you acquired. So culture fit that was a very interesting lesson for me, and thankfully happened early, so I got to leverage that later. And then on the selling the company side, it's kind of the flip of the coin, really, of like, what's it going to be like to be part of this other company, and is it going to be good for that? When we were selling HelloSign, our big kind of criteria, we had a great path forward, staying on our own. But it was like, is this going to be better? Are we going to get better support, more investment, reach to new customers faster than we could on our own, global expansion faster than we could on our own, and will it be a good home for our team? And the answer to every one of those was yes, 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 yes. So that was kind of how we made the call.
If one of those tick boxes doesn't work, is there a way of making it work in some way?
You mean pre or post acquisition?
Post, so.
Yeah. I guess it depends on how big the delta is. We actually had a hard time due to some system challenges that I don't need to go into, post-acquisition, in starting to do bundling and joint selling and things like that. So we kind of had to re-architect some of the back-end systems to do that. And that was one example where I think we all thought we were just going to hit the ground running on joint selling. And we're like, oh, small hiccup. We can work around it, Band-Aids, but so I think you can fix a lot of things post, probably not everything.
But I suppose culture is still definitely quite a big one, isn't it?
Yeah, it really is.
Cathy, I think, was it ThoughtSpot, or no, what was the company?
ThoughtSpot did acquire not the company recently.
Can you tell us anything about what happened there, in terms of the story?
Yeah, I mean, I would say I'll zoom out a little and share some common kind of learnings about startup tuck-ins during this period of time. I think a really, really interesting dynamic that we've seen over the past couple years is that cash went from becoming from being almost free, right? It was so easy for founders to raise money, to all of a sudden now we're in this environment where it's really hard to raise venture funding, right? It's really hard to get other types of funding as well. So cash has become king again, right? That's certainly what it feels like out there. And so you have an interesting dynamic where there's many startups that raise significant amounts of capital in 2021. They have that cash sitting on their balance sheet. Hopefully they've reduced burn, but growth has slowed down because it's a tougher macro environment to sell. And they may no longer be worth the valuation, their last post-money valuation at whatever round they raised in 2021. But they have this cash on their balance sheet, right? And that's worth something. That's worth something to a lot of people. So I'm seeing this interesting dynamic now where other VC-backed startups will say, just as Whit was saying, there's a checklist you're kind of going through on deciding whether or not an acquisition makes sense. And at the highest level, and I used to be a M&A banker, so I used to think about this all the time. It's like, is this transaction going to be accretive for both sides? And what accretive really just means is, hey, does 1 + 1 = 2 or greater? Like, hopefully more than that, right? And so we're seeing this idea now where companies are acquiring other venture-backed companies, typically for all stock transactions. So there's no actual change in cash, no cash paid out to the party being acquired. And then the combined entity now has more cash on their balance sheet, a bigger war chest. So it's kind of an interesting dynamic, and not every M&A transaction that's happened over the last couple quarters fall into that category, but it's an interesting dynamic I'm seeing happen more and more often.
And is that because a wider exit for both companies when they do that M&A, but it's all, they're basically doing it for stock kind of thing? Is that because bigger exit markets and IPOs, et cetera, further away at this point?
Yeah, that's a great question, Mike, and I have a couple of ideas around why this is happening, right? Number one, there has been what I call incrementalism in SaaS over the past couple years, which means there's been many SaaS application companies that have been very, very narrowly focused, right? Not just a product, but maybe a specific feature. And in this tougher market environment, there's a lot of pressure on companies to consolidate their vendors, to save money and just work with fewer vendors. And companies are all struggling right now to figure out, how do we become the platform play? How do we become the one vendor that's not consolidated, but is a consolidator, right? And so one way to go about that is, all right, you're building a product and there are several other features and products that are immediately adjacent. You can either build those yourself, that's going to take some time, right, depending on the complexity, or you could acquire a company.
So it becomes a big roll-up market in a way, doesn't it? Yeah.
Yeah.
Right. And speaking of roll-ups, and I know, Megan, you were part of 8 early-stage exits at Entrepreneur First?
Yeah, 8 or so.
So what are some of the learnings you had during that period? And obviously that was more at the early stage. And what kinds of motivations did the entrepreneurs have? Was it to join a bigger company? Was it burnout? What was it?
Yeah, I think motivations are always very different and very founder dependent. But actually, the story that you shared, Whit, the first story around stepping away from an early stage acquisition because of the culture fit, hearing you tell that story, actually, I think there's some really core founder advice in that. I've seen it time and time again when an early stage company, maybe 1 to 3 years in, gets approached by a much larger company or gets into a conversation with a large company. And if you're a technologist or you're building your company for the first time, it's really hard to know how to approach those conversations. You're really swimming in deep water. And so for a lot of founders, their immediate reaction to that is like, ooh, I can't share too much. I don't want to, in case this doesn't work or in case something goes wrong, the immediate reaction is I want to hold my cards close to my chest. And I think the impact of that often is, as an acquirer, you're like, who are these people? I haven't had a chance to get to know them. And so I think I've seen lots of successful acquisitions, fortunately, but I've also seen where they go really wrong. And often it's just founders thinking that they need to keep things quiet.
Do you think we're in a market where early stage founders probably maybe feel more under pressure? Perhaps they can't raise another round. There's a lot of that going on right now.
Categorically, yes. There's a lot of pressure. And I also think for a lot of founders, another mistake or another thing that they, in shooting for, I want this massive exit and I want to IPO, there is a trend of not starting those conversations early enough.
Yeah.
And so I think it's changing a little bit now in terms of the market turning, but you never want to be having those conversations in a position where your company is in difficulty. Exactly as Cathy was saying earlier, you're buying a business.
How early should the founders startups start those conversations, and what sort of relationships, what sort of blunt conversations should they have with their board and their investors on the board? What do you think, Whit?
Well, I think there's leaving the board out of it for a moment and investors. One of the things I loved and I think was a big learning for me at HelloSign was the founders were very open to whatever the right exit was, and not predetermined on, oh my God, it has to be an IPO or it has to be a strategic acquisition. It was much more, let's build a great business that delivers a lot of good value that customers love. And if we do it right, we'll have every option on the table. And I just thought that was such a refreshing point of view and so smart, because that's exactly how it worked out. Like I said, we had a great path to keep going on our own, but we also had this, great offer from a really good partner that checked all the boxes, and we felt we'd be better off doing that. So I really think that's a very healthy approach. I can't wait to hear what you guys have to say about this. But the idea of let's build a great company that delivers a lot of value and makes customers happy, and if we do it right, we'll have all the options on the table, I think is exactly the kind of early alignment conversation that you want to have. There are absolutely founders who are dead set on an IPO,
do you think
and that's a very different conversation.
During the bull run that founders lost sight of that?
Yeah, a little bit, or at least it got maybe a little blurry. It was very easy, as you said, money was so cheap, it was easy to raise, and, founders, look, every founder has to have this crazy dream and a lot of faith.
Yeah.
And obviously the big dream is ideally an IPO. So yeah, I think it probably got a little fuzzy there for a while.
Cathy, what sort of metrics do you think startups should gather in their sort of their strategy in this time to head towards the right path to an exit?
So,
is it all the kind of standard ones like customer lifetime value and things like that? Are there anything that people forget that is quite important?
So first of all, I want to just plus one on what just said. I think what I advise my companies that I work with is to keep an open mind, but always go back to first principles. You want to build the best company that delivers the most value to your to your customers. That's number one. But for later stage companies that are aiming for IPO, right, there are certainly metrics that they should keep in mind, right? You should also say, like, I want to shoot for IPO in 2026. You should have a general sense of what metrics you need to hit to make that a reasonable and practical outcome. And from an IPO or public markets perspective, there's all the typical things, right? Like there's the scale and growth rate, but there's also, and Instacart has been a really, really interesting case study to watch over the past day or so, a real turn towards profitability and metrics like the Rule of 40 and other efficiency ratios taking a much more important weighting than historically when companies were smaller, growing faster, but they were still able to IPO at nice valuations.
I see. So you've got to hit those basics, haven't you? What about at the early stage, Megan? Should companies, obviously they want to build good businesses. That's fairly obvious. But what other kinds of metrics should they look for?
Yeah, it's a great question. For the earlier stages, I mean, if we're broadly separating the acquisition market maybe into three parts, there's the acquihires, there's the kind of maybe product line acquisitions, and then on the higher scale, it's like the company acquisition, so in the scale of like a Salesforce buying a Slack. So like taking those three, I'd say for the acquihires, it's really just building the best possible product. So unique technology, a unique platform that will provide additional value to a large company. In the second, acquiring a product line, really there it's efficiency.
Yeah.
I think revenue scale matters less, but can you show that getting that revenue is efficient to the business? Burn is low. And on the third side, it's that what you mentioned earlier about, is this business, commercial business that you've built, accretive to the larger business. It needs to be self-sustaining. And so across all of these things, I'd say the thread is cash is king. Cash flow, you need to really understand the efficiency of your sales.
And perhaps, go.
Yeah, I was just going to make an additional point. One of the things I love about Insight Partners is that we actually have a team of people focused on helping our companies and founders think through, should they go through an M&A, and how to evaluate all the things we're talking about that matter. Because I don't think that, especially a first-time founder or somebody who hasn't gone through an acquisition before in any way, it's hard, it's complicated. There's a lot of questions to answer. And so I love the fact that we've got this set of people who are experts at this to kind of help our founders think it through. Like, what should I be thinking about? What should I ask? What should I be looking for? What's a red flag? And that's something that we are just really proud to be able to do and kind of lend an extra hand in the process.
I'm sure.
Mike, can I add something? This is an advice to all the founders who are out there. One thing I always counsel my portfolio companies to think about, no matter how early, and my earliest portfolio company is a Series A company, so fairly early, I always ask them to have a point of view on what makes your business strategic to others, right? And strategic is a term that can mean a lot of different things, but really sharpen your pencil on, hey, do you have a customer set that could be really, really interesting to someone else? Do you have a product that fits really nicely with another company? Do you have a unique distribution channel that other people would be really excited to get their hands on, right? So you don't have to think about exactly who your specific potential buyers might be, but just think about what makes your company unique and special.
Yeah, right. I wanted to ask all of you about obviously the trend that's on everyone's lips these days about generative AI. Because what's going on, obviously, is you have the kind of the wider economy, you have the technology industry, and then along comes this sort of magic fairy dust called generative AI, which I think 3 years ago they used to call blockchain, whatever that was, and it was sprinkled along on pitch decks. And now they've taken out the generative AI fairy dust and sprinkled it all over. But more seriously, there are obviously now startups out there who might have been trundling along in the SaaS space, for instance. Perhaps they, big data plays, machine learning, whatever. And now they've gone, wait a second, let's plug in this kind of rocket fuel called generative AI, and bang, it's actually, in fact, I was actually talking to a company last night at dinner, at the speaker dinner, saying that they'd tried for ages to make this thing work, and then they just applied these Gen AI algorithms, and it just had taken off. And I was like, okay, I'm sure, well, you are talking to a TechCrunch journalist, but so obviously it's taken off. But that's probably fairly true to some extent, isn't it? There are companies that have done that. So we've got the sort of wider economy, and now this transformative new technology that's actually going to sort of throw some petroleum onto the fire of some of these companies. So are we going to see, therefore, some companies go, oh, by the way, now Microsoft have bought us. Hello, kind of thing. Do you think, Megan?
I mean, absolutely. I think Microsoft specifically have to some extent made their bet in the AI space. Yeah. But for sure, I think it's hard to say at this point, but it seems pretty certain that the other cloud players will also be making strong bets here. And so it's kind of a strange place for the acquisition markets. Like the thing I mentioned earlier around the kind of 3 different buckets of companies, I think it'll be really hard for a lot of these early stage AI platforms, AI infrastructure, research-driven companies to show any kind of sales efficiency. And it's not really what they're built for. And so my prediction is that we're going to see this kind of blurring between acqui-hires and buying a product, buying a company. And so it'll be acqui-hire in terms of bringing in PhD talent and bringing in this research talent, which is very scarce, with the valuations that you'd be seeing for buying a product business upwards of kind of 100, 200 million, 300 million, maybe even up to $1 billion for some.
Yes, especially because some of those seed rounds are being blown up because of the Gen AI aspect. Cathy, what's your view on this subject?
I think we're already seeing it happen, right? We're seeing specific companies already adopting Gen AI features in their tool and seeing significant revenue, right? The category that jumps top of mind initially are companies focused on creators. And it makes sense, right? It's natural affinity what Gen AI does for what creators need to do in terms of creating a complete new modality that's easier to allow them to create faster, ideally better, more iteration. But I'm seeing it with other companies as well, in particular around vertical SaaS, which has been super interesting, right? So if you imagine any sort of company that has unique data set, and by adding Gen AI, you're creating a new user interface that makes it easier to access the data, easier to get value out of that data. Theoretically, like, your company will be worth more because your users are getting more value out of it. So I do think it's still early days, but it's something that I'm eagerly tracking.
Whit.
Yeah, definitely early days. Agree. It's only been, not even a year yet since the ChatGPT phenomenon sort of woke everybody up to the possibilities of Gen AI. But I mean, we've invested already more than $4 billion in AI ML companies with across 70 or so deals, which it says a lot. I mean, there's just a lot out there. And I'm really excited that we're living in the midst of seeing this change and seeing all the possibilities that you're talking about, Cathy, of kind of, you get better data, you get to better data faster, you get to higher quality, you get inspiration, you get all these amazing things from this technology. So I really think it's very early days. I think we are going to see acqui-hires in the near term and probably more strategic consolidation downstream. But what I'm excited to see is I don't think we're seeing even just the tip of the iceberg yet. I think there's so much more possibility that we're going to see every kind of technology company leveraging AI in some capacity to create better experiences, to deliver more quality, all the things that we're talking about that can be done. But I also think we're going to see emergence and consolidation of things on the infrastructure side and the pure play AI offerings. So that's going to be fun to watch too. And I think somehow these things are all just going to sort of play together until we start to see some patterns emerge, and it's just too early yet.
Very interesting. It is very interesting, isn't it?
It's a lot of
we
fun.
are living through quite a transformative period, I think. In the closing moments of this, I'm going to set you all a task. I'm going to turn you all into journalists. And what I'd like to do is to ask you all to think of yourselves as reporters and reporting back from the VC lands and the VC networks and the circles that you move in. So what is the chatter amongst your colleagues? Give us some insight about, because obviously VCs, they have LPs, they need to return the fund. What is the chatter amongst your colleagues? Perhaps you don't necessarily have to reveal too much about your own firms, but over the cocktails that you might go to, what can you report back to us? Breaking news, Whit, amongst your colleagues in the VC world.
Yeah, I mean, interesting enough,
exits.
we really have an AI-specific chat room with, I don't even know how many people are in it, I don't know, 60, 80 people across the firm. And so we are having this dialogue literally around a virtual water cooler kind of every day. And I think there's...
And is the chatter about exits and selling?
I think it's really across three key themes. One is we're helping to educate each other because there's so much happening across this space that no one person can track everything going on.
Yeah.
So sharing headlines, sharing interesting stories, sharing learnings, and sharing funny things that you come across that are entertaining in the AI space. So that there's education, I think, is one big thing. And of course, there's lots of fun, critical chatter that goes along with that. Like, well, that sounds really stupid, actually, those kinds of things. I think the second theme is, how should we think about investing in the space? And how conservative versus aggressive do we want to be? And so I think we're sort of, I would put us sort of in the middle ground of, like, obviously if we've already done 70 plus deals in the AI ML space, I mean, that's pretty widely scattered. But most of it has been sort of in the business-oriented platforms, infrastructure, tools that help companies do better work.
But let me help you along the journey. Are you positive or negative about the next year or couple of years?
Oh, very positive.
Right.
Very positive.
Okay. Cathy?
I've never felt more excitement and optimism from the VC community.
In
People
what way?
are excited about the companies that are being founded right now.
Right.
The growth trajectories that we've seen for some of them, and not all of them are AI companies, let's just be clear, a lot of them are, but not all of them. There's good quality businesses now, and unlike what we saw in 2021, founders are now realizing, hey, like, investors care about efficiency, right? Cash is king. I should make sure that I'm growing my company smartly. But we're seeing companies grow, and it's because they have great technologies and products, right? And they're being smart in terms of their go-to-market strategy. And that's very exciting. The other big topics amongst my group is, for our current portfolio companies, right, that are facing headwinds, how can we be there for them? How can we do more to help them through this tough time?
So we're back to a startup market, is what you're saying. We're back to the early stage again.
Oh, it kind of feels like that some days.
A reset.
It kind of feels like that some days.
It does feel like, Megan.
Yeah.
I feel like you're digging for gossip. And
Of course.
I don't, and I'm not going to air the gossip.
Was it that brazen?
Just outsourcing your job. But I, maybe as a relative outsider to Silicon Valley, as you can probably hear, it's not a native Californian accent. I think something I've been surprised by here versus investing in Europe, where I've been investing for the last 6 years, the amount that the investment markets seem to be influenced by what specific investors are excited about. From the outside, you know that the larger firms, like the Insights, the Sapphires, the Sequoias, who are driving these markets and investing in specific spaces, you kind of see that from the outside in London, but you're a little sheltered from it. Whereas here, it's just such a driving force in what everyone tends to look at, and it's work in separating yourself from getting too brought in on the hype, and I think that's also important for founders. Just one insight.
So I guess to summarize, keep your eye on the prize, as it were, to some extent.
Yeah, it's easy to get distracted here.
Yeah.
I've felt that.
Well, I mean, I've really enjoyed our conversation. Thank you so much for coming to
Thank you.
TechCrunch Disrupt. Thank you for turning into my reporters on the ground. I'll be tapping you for stories in the future, of course. But ladies and gentlemen, please give a warm round of applause to Whit Bouck from Insight Partners, Cathy Gao, Sapphire Ventures, and Megan Reynolds from Vertex Ventures. Thank you so much.